The screens went quiet at exactly 9:30 p.m. Sunday night. It wasn't the loud, chaotic quiet of a crash. It was the wrong kind of quiet. The kind where you're staring at the COMEX feed and the LME terminal, and everything looks clean, everything looks orderly. But meanwhile, the physical backbone of the global economy is having a heart attack in real time, and nobody is talking about it. I am a private commodities analyst. I've been tracking metals and stacking silver for 12 years. I built this channel for one reason. I got tired of watching the mainstream media lag 12 hours behind what I was seeing on my Bloomberg terminal. This AI avatar is just the fastest way to get the raw intelligence out to the people who actually care about protecting their wealth before the headlines catch up. Right now, while you're hearing CNBC analysts call this a speculative New Year's rotation, or chalking up $12,500 copper to AI infrastructure hype, I'm watching something completely different unfold. They want you to believe the supply will eventually catch up. They want you to focus on the price. But the price is not the story. The story is the pipes. The plumbing of the global metal trade is backing up, and we are not looking at a rally anymore. We are looking at the total depletion of available physical refined copper, the kind of depletion that does not get fixed with a press release or a Federal Reserve rate cut. The media keeps saying there is plenty of metal in the system. But the inventory data I am looking at says we have less than 72 hours of buffer left. Someone is lying to you. The price is about to tell us exactly who. Here is what I'm going to lay out for you today. We have hit what I call a perfect storm. The Grasberg mine disaster, combined with a financial anomaly most people have never even heard of called negative smelter treatment charges, has pushed us past a tight market into a terminal physical shortage. And I need to be clear about what that means for your portfolio. We have entered a phase where the paper price on your screen no longer dictates what you will actually pay to get physical metal in your hands. Price discovery is happening in real time, and it is messy. In this video, I'm going to break down the mechanism behind these negative treatment charges, the hidden force that is quietly killing smelters across the globe. I'm going to run the actual forensic math on the 600,000-ton deficit that JP Morgan and Goldman Sachs are terrified of. And at the end, I'm going to share my personal battle plan for what I am doing when COMEX copper hits the $6 wall. Because once you understand why smelters are paying miners to take their ore, you will realize why the banking system is suddenly very, very nervous. Let's start with where we are right now. Hard numbers, no fluff. As of earlier this evening, LME copper is sitting at $12,000 to $937 per metric ton. That is up 42% from where we were this time last year. COMEX copper is trading at $5.91 per pound, staring directly at the $6 psychological barrier that everyone in this space is terrified of. But this is not just a copper story. Silver is trading at $72.75 per ounce. We are seeing contagion across hard assets, and it is not subtle anymore. And here is the fuel. The dollar index, the DXY, is sitting at 140. It is starting to show structural cracks. When the dollar weakens and metals run, that is the setup for a supercycle. Now, I want you to stop and actually look at the inventory numbers with me. LME copper stocks are at roughly 145,000 tons. In the last 48 hours, over 2,000 tons just disappeared. Gone. Let me put that in perspective for you. At current global consumption rates, 145,000 tons represents less than 3 days of supply. 3 days. That is not a strategic reserve. That is a rounding error. Here's where it gets uncomfortable. I've been watching the paper markets show these clean, orderly prices while I'm getting unverified reports, and I will label them as such, from retail dealers like SD Bullion, who are allegedly moving to pre-order only models because they cannot source physical blanks. The screen says everything is fine. The physical market is saying something very different. The inventory is draining at a rate that makes a force majeure event look less like a possibility and more like a certainty. Now, let's talk about the mechanism that most people do not understand. This is the core of why the shortage is so severe. It is called negative treatment charges, TCs. Here's how it normally works. A mining company digs ore, which is just dirt with copper in it. They pay a smelter to turn that dirt into refined metal. That fee is the treatment charge. Simple. But right now, treatment charges have gone negative. That means the smelter is actually paying the miner for the privilege of refining their ore. Let that sink in. The smelter is losing money on every single ton of copper they produce. Why would they do that? Because you cannot just turn a copper smelter off like a light switch. If the furnaces go cold, you destroy millions of dollars in infrastructure. Think of it like owning a $50,000 industrial juicer. If you don't keep oranges running through it, the machine dies. So even if there is an orange shortage, you start paying people to bring you oranges just to save the machine. That is exactly what is happening to copper smelters right now. They are cannibalizing their own capital just to stay operational. But When they finally bleed out and shut down, the supply of refined metal doesn't just dip, it stops. Now, let us run the actual math on the deficit because the numbers are worse than most people realize. Freeport-McMoran's Grasberg mine, one of the largest copper mines on the planet, had a major accident. That disaster has officially removed 313,000 metric tons from the 2026 supply forecast. JP Morgan and Goldman Sachs are both projecting a global deficit between 330,000 and 600,000 metric tons for this year. But here is where it gets even more interesting. There are unverified rumors, and again, take this as intel, not fact, that China's state grid is quietly hoarding an additional 20% beyond their normal reserves. If that is true, the actual deficit expands to nearly 800,000 tons. Let me frame the impossible equation we are facing. We have a 600,000 ton hole in global supply. We have only 145,000 tons sitting in the LME warehouse. You cannot subtract 600,000 from 145,000 and expect a functioning economy on the other side. The math is telling us that the price has to go to a level where demand is forcibly destroyed, where industrial users simply stop using copper because they can't afford it. That is not speculation, that is arithmetic. Now, I know what the skeptics are going to say because I've heard it a dozen times already this week. Aluminum substitution will save us. The argument goes that at $12,500 per ton, engineers will just swap copper for aluminum. Let's pull that apart. Yes, aluminum can replace copper in some cheap wiring, but you cannot swap copper for aluminum in a power transformer, a data center, or a high-performance EV motor overnight. You're talking about re-engineering entire systems, retooling factories, and recertifying components for safety standards. That process takes 18 to 24 months minimum. We have a 3-day inventory problem. Do you see the disconnect? The substitution argument assumes we have time. We don't. Here is the other lie. High prices will bring out the scrap. People think the market will just find old copper pipes and wires to recycle. And yes, high prices will incentivize scrap collection. But scrap is a one-time event. It is not a renewable resource. Once you strip the copper out of every condemned building, that's it. You have exhausted the pool. Scrap does not replace a mine the size of Grasberg. It doesn't replace 313,000 tons of annual production. The scrap tsunami is a temporary bandage on a severed artery. It might buy the market a few weeks, but it doesn't solve the structural problem. So what happens when the Band-Aid falls off? We are about to see the exchanges panic, and you need to know exactly what signals to look for before they change the rules. So what happens next? What should you actually be watching for before the news hits the wires? First, watch for the exchanges to panic. I'm expecting the LME or COMEX to hike margin requirements by 50% or more within the next week. They will frame it as ensuring orderly trading. But what they are really doing is trying to force out the speculators to save the system from breaking. Second, and this is the big one, watch for whispers of cash settlement. There's an unverified rumor circulating about a 5,000 contract delivery failure. If a major bank cannot deliver physical copper, and the exchange forces them to settle in cash, the paper market has officially decoupled. The game is over. Here is my personal dashboard. These are the 3 triggers I am watching in real time. Trigger number 1, $6 COMEX copper. That is the line between a rally and a mania. If copper breaks $6 and holds for 3 consecutive closes, I am mentally shifting into parabolic mode. Trigger number 2, LME stocks dropping below 100,000 tons. If inventory drops under that level, I'm expecting an exchange level force majeure. That is the point where industrial users start panic buying and the whole system locks up. Trigger number 3, the gold to silver ratio. If it drops below 60, that tells me silver is leading the charge. It means the hard asset contagion is accelerating, and copper is just the canary in the coal mine. So here is my battle plan. This is what I am doing with my own money. If copper hits $13,000 on the LME, I'm personally taking 25% of my mining equity profits off the table. I don't want to be the last person through the exit when the music stops. If silver dips back to $65, I'm buying that dip with both hands. And if the exchanges hike margins by more than 30% in a single day, I'm sitting on my hands. I do not trade in environments where the referees change the rules in the middle of the game. I am not here to tell you what to do with your money. I am here to show you what I am seeing with mine. And what I see is a market that is running out of time and running out of metal simultaneously. This is not a financial crisis. This is a physical crisis with financial consequences. The screen says the price is fine. The physical reality says the price is whatever you have to pay to actually get metal delivered to your door. But if you want to understand how this physical squeeze is already spilling over into the silver market, because trust me, silver is moving faster than copper right now, you need to watch this breakdown on the silver price discovery phase right here. The dynamics are eerily similar and the clock is ticking even faster on silver inventory. Click this video now, and I will see you there.